Welcome to the Deep Dive, the show where we like to really dig into complex topics, pull out the most important stuff, and make sure you're in the know without wasting any time. Today, we're diving headfirst into, well, a pretty foundational concept in the audit world.
Yeah.
We're looking at ISA 210, agreeing the terms of audit engagements. You can kind of think of it as like understanding that initial handshake, between the auditor and the company being audited.
Absolutely. This standard, it's effective for audits of financial periods starting December 15th, 2009 or after. It basically outlines what the auditor needs to do, to make sure they're on the same page with management and with those who govern the entity about what the audit will actually involve. And it even touches on the very first decision of whether to accept or continue an audit engagement at all.
So, at its core, the objective of any audit, as this ISA 210 lays out, is to have the auditor give their opinion on whether the financial statements are presented fairly, following the relevant accounting rules, giving assurance to stakeholders. And what we're aiming for today is to kind of unpack the essentials of that agreement, to paint you a clear picture of what's really involved.
Right.
So let's dive right in. What needs to be in place before an audit can even get going?
Well, ISA 210 really stresses these preconditions for an audit.
Right.
The auditor has to figure out if these sort of fundamental conditions are actually met. It's all about ensuring everyone's playing by the same rules and has a shared understanding of the ground rules from the get-go.
Makes sense. And what are these foundational requirements? What needs to be there?
Okay, so the first big one is that the financial reporting framework that the company's using, it needs to be acceptable. This framework, it's got to be suitable for the entity, for the purpose of those financial statements. So it makes sure the financial information, it's presented in a way that anyone can understand and that it can be compared to others. It's like imagine trying to compare two companies' performance if one's just making up their accounting methods.
Yeah.
That's what we're trying to avoid here, that lack of comparability.
Makes total sense. You need that consistent, recognized set of rules before you can even start assessing financial health.
Right.
What else is on that list of must-haves?
Well, management, they have to acknowledge and really understand their responsibilities. It's a three-part obligation.
Oh, wow. Okay.
First off, management's the one responsible for preparing those financial statements according to the framework everyone agreed on and making sure they're fair, where applicable.
So the auditors aren't the ones actually making the statements?
Not at all. Nope.
Yeah.
The second part is management's responsible for setting up and keeping up those internal controls. The ones that are needed to make sure the financial statements are free from any big misstatements, whether it's an honest mistake or, something more intentional. It's like, think of it this way. The auditor, they come in to check the engine, but it's management that builds and maintains the engine in the first place.
Right.
Without that solid foundation, the audit opinion, it loses some of its power.
Yeah, that makes sense. So they build and maintain the financial machinery, and the auditors are there to inspect it. What's the third part of their responsibility?
Okay, so the third piece, this is crucial, is that management has to give the auditor unrestricted access to the information they need.
Okay.
All the records, documentation, anything related to the financial statements. And they need to be ready to provide anything extra the auditor asks for during the audit. Plus, the auditor has to be able to talk to anyone in the company they need to get that audit evidence.
Wow. So that's a pretty serious level of access and cooperation management has to provide.
It is.
What happens if the auditor, runs into limitations, can't do their work the way they need to?
This is a really important point.
Yeah.
The standard says if management, or those charged with governance, they put up these roadblocks, limit the audit scope so much that the auditor thinks they'd have to issue a disclaimer of opinion, basically saying, hey, I couldn't even form an opinion because of these limitations.
Right.
Then the auditor shouldn't accept that engagement. Unless, of course, it's legally required.
So if they can't get the access they need to give a reliable opinion, they should just walk away.
Generally, yeah. And the standard is really clear.
Yeah.
If these preconditions aren't there, the auditor has to talk to management and say, look, I can't take this on.
Wow.
It's about protecting the audit process itself, keeping it honest and effective right from the start.
Okay, so once those basic conditions are all met, what's next? How do they formalize the agreement?
Well, the auditor has to sit down with management or those charged with governance and agree on the terms of the engagement.
Right.
They need to put it all in writing, usually in an engagement letter, although other forms of written agreements are okay too. The main thing is that it's clear and everyone's on the same page.
And what are the essential elements that need to be in that written agreement?
There are a few key things.
Okay.
First, it has to clearly state what the audit's all about, the objective and scope, exactly what the auditor will be looking at. Then it needs to spell out the auditor's responsibilities.
Okay.
And of course, management's responsibilities, which we've talked about, are pretty substantial. Then there's identifying the specific financial reporting framework they'll be using.
Right.
And finally, it should say what the auditor's report is expected to look like, its form and content, but with the caveat that, things might change. The actual report might look a bit different due to unexpected things that come up.
Right. Right. That makes sense because you can't always predict every twist and turn in an audit, right?
Exactly. Audits rarely go exactly as planned. There are always surprises.
Yeah.
So that flexibility is important.
Okay. So that last point about the report format maybe changing, it kind of highlights how unpredictable audits can be.
Right.
What happens if some of those responsibilities are already laid out in like laws or regulations?
So when there are laws or regulations dictating the responsibilities for management or those charged with governance, the auditor needs to make absolutely sure that management understands those responsibilities and that they're included in the written agreement.
Right.
And similarly, if there are laws or regulations that outline the auditor's responsibilities, and they're basically the same as the ones in the standard, the auditor can just use the wording from the law or regulation.
Gotcha.
If not, they should include those standard responsibilities in the agreement just for clarity's sake.
So it's all about making it crystal clear who's accountable for what and what the expected outcome is with that built-in flexibility for the unexpected.
Yeah, exactly.
Okay, what about audits that happen every year with the same client? Do they need a whole new agreement each time?
That's a good question. For those recurring audits, ISA 210 says the auditor has to check if anything's changed, any circumstances that would mean revising the terms of the engagement. They also need to think about whether it's enough to just remind management about the existing terms, like maybe the company's operations changed or there are new regulations. Anything like that could mean they need to update the agreement.
So it's more like a check-in and confirmation, not starting from scratch every single year.
Exactly.
Now, what happens if, like in the middle of the audit, one side wants to change the agreed-upon terms? Can they do that?
Well, they can ask, but the auditor really needs to be careful. The standard says the auditor shouldn't agree to change the terms unless there's a really good reason. Like, for example, if a company wants to limit the scope because they found a big problem, well, that wouldn't be a good enough reason for the auditor to agree to a smaller scope.
Right, that makes sense.
Yeah.
You can't just change the rules midway through because you might not like the outcome.
Right.
What if the client wants to switch to a different kind of engagement, one with less assurance, like a review instead of a full audit?
If that happens before the audit's finished, the auditor has to decide if there's a valid reason for the change.
Okay.
They have to be extra cautious if it seems like the client's trying to avoid a bad audit opinion,
Right, right.
If they do change the terms, then both the auditor and management have to agree on and document those new terms, either in a new engagement letter or another written agreement.
And what if the auditor says, no, I don't agree with this change, and management says, well, you can't continue with the original plan then? What happens then?
In that case, the standard says the auditor has to withdraw from the engagement.
Wow.
It really emphasizes how important the auditor's independence is and the integrity of the process. You can't compromise on that.
Yeah, that's a big deal. Really underscores the need for that strong, well-understood agreement from the very beginning to avoid situations like that.
Exactly.
Now, ISA 210 also mentions some other things to think about when deciding whether to accept an engagement, right?
It does. One key area is when you have those financial reporting standards set by, an authorized body, and then they're supplemented by laws or regulations.
Okay.
If there's any conflict between those two sets of rules, the auditor needs to talk to management about it and figure out how they're going to address those additional requirements. It's about navigating those potential overlaps or contradictions.
Gotcha. So it's about complying with everything, not just picking and choosing the rules you like.
Right.
What about those times when the financial reporting framework that's required by law or regulation, what if it's not actually the most appropriate one?
That's a tricky situation.
Yeah.
The standard acknowledges that sometimes you might have a framework that's legally required, but it wouldn't be considered acceptable otherwise.
Okay.
In those cases, the auditor should only accept the engagement if certain conditions are met. One important condition is that management agrees to include extra information in the financial statements beyond what that framework requires.
Okay.
Those additional disclosures, they're meant to help make sure the financial statements aren't misleading, even though they're prepared using a framework that's not ideal.
So they have to go above and beyond the minimum legal requirements to make sure the picture is more complete and accurate.
Yeah, exactly. And if those conditions aren't met, but the auditor is legally obligated to do the audit anyway, then they have to figure out how that potentially misleading nature of the financial statements will affect their report. They might have to include disclaimers or explanations to highlight those concerns. And the standard also mentions that if the law or regulation dictates a specific format for the auditor's report, the auditor has to think about whether people might misunderstand the audit and what that prescribed report actually means.
Right. All these extra considerations really highlight how complex it can be for auditors.
Yeah.
With all these different regulations and reporting standards, it's not always black and white.
Absolutely.
Now, let's take a look at that application and other explanatory material section of ISA 210. Anything important in there for our listeners?
Definitely. It adds valuable context and clarifies some of the core principles.
Okay.
Like it reminds us that ISA 220, revised, takes a deeper dive into the auditor's ethical responsibilities, including independence, which is, absolutely crucial for an audit to be credible.
Yeah.
It also reinforces that point we talked about, that management is responsible for internal control and making sure the financial statements are free from material misstatement.
So even though ISA 210 focuses on the agreement itself, it's tied to these bigger ethical and control considerations, which are explored in more detail in other standards.
Right.
What else is in that explanatory material?
Well, it gives us more detail on the engagement letter, saying that how it looks and what it includes can vary depending on the company.
Okay.
But it does lay out some common elements that are usually included, like it might include a more detailed explanation of the scope of the audit, referencing specific legislation, regulations, ISAs, and ethical guidelines the auditor follows. And it could specify the format of any other communication coming out of the audit.
Right. So the engagement letter is like a roadmap for the entire audit process.
Exactly.
Sets expectations and responsibilities.
Yeah.
Are there any other standard clauses or points that are usually in these letters?
Yeah, there are a few.
Okay.
It's pretty standard to have a statement acknowledging the inherent limitations of an audit. That's basically saying that even if the audit is planned and done perfectly, there's always a chance some material misstatements won't be found because of things like fraud or the nature of the evidence. The letter might also outline how the audit will be planned and carried out, including who's on the audit team. And importantly, it usually says that management is expected to provide written representations to the auditor on certain things.
So it's a two-way street, laying out what the auditor will do and what they need from the client in terms of information and assurances.
Precisely. The explanatory material also gives examples of other things that might be included, like arrangements involving other auditors or experts, the role of internal auditors, details about fees and billing, and any limitations on the auditor's liability.
Right.
It's all about defining the relationship between the auditor and the client, making sure everyone knows what to expect.
Sounds like this engagement letter is a pretty comprehensive document, like the foundation of the whole engagement.
It is.
Okay, last but not least, ISA 210 has an appendix that gives guidance on figuring out whether a general purpose framework is acceptable, right? What are the key takeaways there?
Yeah, Appendix 2 gives some important guidance on that initial assessment.
Okay.
It points out that if a framework requires compliance with its own rules and those of another framework, it might not be considered acceptable. That's to avoid any inconsistencies or ambiguity. And it reinforces something we discussed earlier. Even if a framework is legally required, it could still be deemed unacceptable if it would result in misleading financial statements.
Right.
The goal is to have financial statements that give a true and fair view of the company's position and performance.
So it all comes back to that fundamental goal, providing useful and reliable financial information to those who need it. Well, this has been a really fascinating deep dive into ISA 210. We've covered a lot, like the importance of those clear audit terms from the get-go, those critical preconditions, the key elements of the engagement letter, what happens if you need to change the terms, and the added complexity of different regulations and frameworks.
Yeah, a lot to unpack there.
Our goal was to give you, the listener, a solid understanding of the core principles of ISA 210 without getting bogged down in too much technical jargon.
Right.
So here's a final thought for you to ponder. Given how detailed these agreements are, what are the potential challenges in making sure both the auditors and management really understand their responsibilities throughout the audit? And how might any difference in their understanding ultimately affect the reliability and transparency of the financial audit? It's a question that really highlights how crucial these initial agreements are in the big picture of financial reporting and accountability.
It is.
Thanks for joining us for this deep dive.
You're welcome.